Welcome back to Reformed Thinking. Today we're doing a deep dive into something that, requires a lot more than just good intentions. We're going to be examining sustainable public policy, and that really means looking at rigorous structures. It means cold, hard accounting. Our mission here is to unpack the financial architecture a country needs to sustain itself through a long war. We're using Ukraine as the case study, of course, and we've been looking at source material from financing Ukraine for the long war, and the whole focus is on building a sustainable system, something that moves way past the political high you get from just one-off aid packages.
That framing is the absolute starting point. It has to be. When a nation is in a state of, extended conflict, its public finance system is tested to its absolute breaking point. The whole game changes. You're not optimizing for future growth anymore. You're planning for immediate endurance. The question isn't about capital markets or long-term yields. It's, can the system physically sustain a fighting force? Can it keep the government running and an economy breathing month after month with no end in sight?
Okay, so let's unpack that. The sources we've looked at identify two central challenges that are interlocked. They make this kind of long war financing so uniquely difficult.
Absolutely. The first is what you'd expect, a massive recurring fiscal gap. War just destroys your production. It collapses your revenue streams. And at the exact same time, it forces these huge spikes in spending.
For defense, obviously, but also for emergency repairs and social welfare.
Tensions, social payments, all of it. That deficit, that gap has to be filled constantly, or the government just fails.
And the second issue?
The second is the war-imposed risk premium. Think about it. Risk capital flees the country. Insurance markets just dry up completely. Borrowing costs go through the roof. So the job of this long war architecture is to systematically solve for both things. You need the sheer volume of cash, and you have to reduce that perceived risk.
So the argument from the sources is that building this durable structure, this organized, predictable system, that is a form of defense in itself.
It is. It really is. The whole goal is to build a portfolio, one where domestic discipline, allied support, and market mechanisms all align. And if you do that, you create a perception of durability. And this is where we get to the core insight of the whole thing. Credibility becomes currency.
Credibility is currency.
Okay. If your own citizens, if markets, if your external allies trust your financial planning, if they believe the support will be stable, they'll participate.
They'll pay taxes, they'll lend money, they'll commit resources.
Exactly. But if that structure is doubted, even for a moment, financial panic can set in, and it doesn't matter how much cash was pledged just yesterday.
That really sets the stage for what the analysis says is the first critical step. And that is rejecting easy political slogans and instead defining the financial problem by its distinct uses.
Right.
Why is it so vital to start there, to define what the money is actually for?
Because if you don't, you're guaranteeing failure. If you treat the entire financial need as just one big, undifferentiated war budget, you're going to misuse the money. Slogans are, politically useful. Support Ukraine. It's simple. But it blurs together four completely distinct financial problems. And each one of those problems demands a radically different financial tool, different oversight, different terms.
And if you get that alignment wrong, you either starve an urgent need or,
even worse, you saddle the future with crippling debt that you used to pay for today's consumption. It's a disaster either way.
So we need to define these four overlapping financial realities. This classification seems to dictate every single funding decision that follows. Let's start with the base layer. Use one, state operations. Just keeping the government functioning.
This is the operational floor of the state. It's about keeping the lights on. It means reliable salaries for public sector workers. We're talking teachers, doctors, emergency services, civil servants. It also means making sure social payments and pensions continue without fail.
And the profile of this need is really specific.
Great.
It's recurring, it's for consumption, and it doesn't generate any revenue.
Right, so it requires absolute cash flow reliability and speed. The money has to be there every single month.
And if the state can't reliably meet payroll for its core functions, that's more than an economic issue.
Oh, it crosses a threshold immediately. It becomes a fundamental governance problem. When a state defaults on its own employees or it can't pay pensions, public trust just collapses instantly. And then what happens? Skilled workers, especially your doctors and engineers, they emigrate. You get a massive brain drain that cripples your future recovery. Tax compliance plummets.
So the financing for these state operations has to be, what, predictable and cheap?
Predictable and highly concessional. The best fit is grant-heavy external budget support. So, gifts. Or loans with extremely favorable terms. You combine that with whatever you can raise through disciplined domestic revenue and maybe some cautious domestic borrowing. But Always within strict macroeconomic limits to keep inflation in check.
Okay, so that's the floor, state operations.
Hmm.
Now, if we shift to use case number 2, defense, capability, and sustainment, the logic here changes completely.
It does. Defense spending is an ordinary consumption. It's an investment in strategic effects.
Deterrence, physical protection.
Exactly. This covers your munitions, fuel, air defense systems, complex logistics, training, cyber capabilities, and also scaling up your own domestic military production. And the critical need profile here is sensitivity to time.
Time.
Delays are catastrophic. They're not just inconvenient. They often lead to immediate military losses, which then exponentially increases the long-term human and financial cost of the war.
Which is why we so often see donors bypassing the general treasury for this kind of support.
They do, and it makes sense. They often prefer direct equipment transfers or direct contracting, especially for classified or very sensitive material. This approach lets experienced defense ministries and donor countries handle the procurement. It ensures speed, and it allows for stringent auditing that's adapted to security constraints.
So the goal isn't just balancing a ledger.
Not at all. The cost is measured in operational terms. Do you have enough air defense to get through the next winter? Do you have the supplies for the next offensive? That's the metric that matters.
Okay, moving to the third use case, recovery. The source material calls this repair under fire, which sounds relentless.
That's the perfect word for it. It's relentless. This is about emergency repair and building resilience. We're talking about patching the electricity grid, restoring a critical substation, fixing a water system, stabilizing a damaged hospital, demining farmland.
And the asset you repair today might just be targeted again tomorrow.
Precisely the dynamic. So the spending has to prioritize speed, of course, but also redundancy and hardening.
What does hardening mean in this context?
It means installing backups, decentralizing your power generation so you don't have single points of failure, using protective structures around critical infrastructure. You're building for the next attack, not just fixing the last one.
And if it's so repetitive and urgent, what kind of financing fits best here?
This is where targeted project-based support really shines. So donors or multilateral development banks think the World Bank or the EBRD, they come in. Instead of just putting cash into the general budget, they fund specific contracts for, say, generators or substations or demining equipment.
The oversight is much easier that way.
Much easier. And it acts as a critical bridge function. It prevents communities and key infrastructure from collapsing permanently long before you can even think about large-scale, comprehensive reconstruction.
Which brings us to the final use case, number 4. Reconstruction and growth. This is the long game. This is about retooling the economy to hopefully one day end the dependence on aid.
This is the highest risk category, especially during an active conflict, because it requires a level of stability that war just inherently destroys. The vision for this is massive. Retooling energy resilience with decentralized generation, opening and securing new export corridors, building new housing, upgrading industrial capacity. The whole point is to build things that can generate future tax revenue for the state.
And this is where the entire structure has to pivot. Away from grants and consumption and toward private investment.
It has to. There's no other way to get the scale you need. These projects require multi-year financing, transparent and enforceable contracts, and a massive tolerance for risk. Private capital has the scale, but it must be mobilized. And it will not move until its unique risks, physical destruction, contract cancellation, currency volatility, are somehow covered.
And the central analytical claim in the sources is that if policymakers confuse this long-term need for investment with the immediate need for, say, monthly pensions, they will sabotage both efforts.
Yes. Mixing these uses guarantees a suboptimal outcome. The urgency of paying salaries, that liquidity pressure will always win. It will always cannibalize the patient, long-term capital that's needed for growth.
Which means reconstruction projects get delayed. Or, even worse, they get financed with short-term, expensive debt.
Exactly. So clarity of use dictates clarity of instrument. It's the foundational principle.
That clarity leads us right into the next section of the analysis, establishing the yardstick. So we know the 4 uses, but you still have to choose the right instrument for each one. A grant, a loan, a guarantee, an asset-backed mechanism. And every single one of those choices carries a distinct trade-off.
And this requires a highly disciplined approach. It really does. Every instrument, from a concessional loan to a commercial guarantee, has hidden costs or risks. Without a common, rigorous set of criteria to judge them by, policymakers will solve a $1 billion liquidity problem today.
By creating a $10 billion solvency crisis tomorrow, through inflation or just unsustainable debt.
Precisely. You have to have a yardstick.
Okay, let's run through the 7 criteria the sources insist must be applied to every single funding proposal. First one, speed. And we've established this is more than just a political pledge.
Speed is existential. It's not a nice to have. And it has to be defined as accessible cash. The question is, how fast can the money be contracted, transferred, verified, and actually spent?
Right. A pledge in February that doesn't show up until August is a crisis.
It's a full-blown crisis. Ministries miss payroll. Social obligations pile up. For defense materials, a delay caused by bureaucracy can lead directly to catastrophic losses on the front lines. The focus has to be on the real disbursement schedule, not the press release.
Okay, criterion 2, predictability. This gets at stability at reducing that multi-year uncertainty.
Predictability is, I would argue, the key to economic stability in this context. If government ministries and businesses, and even just ordinary citizens, if they know the financial backbone will hold for multiple years, they can plan, they can invest, they stay in the country.
And multi-year facilities, which we'll talk about, are designed to prevent what the analysis calls a funding cliff.
That destabilizing panic when short-term aid suddenly runs out. And avoiding that requires really robust coordination among all the major donors to map out the needs and commitments and make sure there are no gaps.
Criterion 3 touches on the long-term consequences, cost and concessionality.
Yeah.
This is really about the debt burden.
This is the true price of the money. It's simple, really. Grants are gifts. They don't compound your solvency risk. Loans, on the other hand, directly increase the national debt stock and your future obligations.
So decision makers have to be really rigorous about the grant-loan mix.
They have to be. And the analysis suggests a pretty strong ethical and political constraint here. The argument is that non-productive consumption needs fear. Things like monthly pensions and civil service salaries should ideally be financed by grants.
To avoid saddling the next generation with debt for services that were already consumed today.
Exactly. It's a matter of intergenerational fairness.
Okay, let's pivot to criterion 4, macroeconomic impact. This is where the temptation for fast, easy money can really destroy the whole system.
This is the hard discipline of wartime finance. Heavy monetization of deficits.
So the central bank printing money to cover government spending.
Right. It feels fast and easy in the short term, but it inevitably leads to destabilizing inflation, a rapid erosion of purchasing power, a currency spiral, and you end up widening the very gap you were trying to close.
So every instrument has to pass this macro test.
It has to. You cannot solve a liquidity problem today by creating a massive currency crisis tomorrow. Holding that line, maintaining confidence in your own currency is absolutely vital.
Criterion 5, legal feasibility and enforceability. This feels crucial for some of the more novel ideas, like using Russian assets.
It's critical. Any major financial proposal, especially something like the $50 billion ERA model we'll get to, or large private guarantees, they have to be legally sound, not just morally justifiable. They have to be resilient to counter challenges in multiple legal jurisdictions.
So if a plan relies on a shaky legal outcome,
like the outright confiscation of Russian principal assets, which doesn't really have an established precedent, you can't categorize that as a foundational backbone. It's supplemental, at best, until the legal path is rock solid.
And for private capital, enforceability means contracts and dispute resolution have to be solid, even in a war.
They have to survive the conflict, yes.
Okay, criterion 6, political viability. How do you plan for elections and donor fatigue in, a dozen different parliaments?
That's the billion-dollar question. Long war support has to be politically robust enough to survive partisan shifts and, frankly, competing global crises. Financial instruments that require an annual crisis vote in a donor nation are incredibly vulnerable.
So the support needs to be institutionalized.
It needs to be institutionalized, framed by a clear and bounded narrative and linked to measurable outcomes that voters can actually understand. Things like the grid is restored or pensions were paid. And domestically, that credibility relies on strict fiscal discipline and visible anti-corruption enforcement. Citizens and donors have to see that the burden is being shared fairly.
And that brings us to the final criterion, number 7, governance fit and absorptive capacity. This brings us back to tailoring the oversight to the specific channel.
Right. Governance is not a one-size-fits-all slogan. The oversight has to be matched to the inherent risk of that channel. For example, over-controlling emergency infrastructure repair with peacetime bureaucracy can be just as destructive as under-controlling a huge reconstruction project.
So governance has to be designed to reduce leakage without paralyzing the speed you need to survive.
That's the balance. And the key question is always, does the state have the institutional capacity, the absorptive capacity, to manage billions of dollars without being crippled by corruption or just bureaucratic paralysis?
When you look at all 7 of those criteria, it's so clear that they're often in direct conflict with each other. The fastest money is often the most inflationary, the most predictable multi-year support is often the hardest to secure politically.
That collision forces incredibly hard choices, and that's what structuring the overall architecture is all about. It's about managing those trade-offs.
Which brings us to part 3, the pillars of sustainable financing.
And we have to start with the bedrock. Pillar 1, domestic financing. This is the first line of endurance. It signals to your allies that you're serious about burden sharing, that you're governable. Without this internal discipline, any external support is just a temporary subsidy.
But given the severe disruption to the economy, what does maximizing domestic finance actually look like? How do you do it without crushing what's left of your productive capacity?
It's about finding a very painful sweet spot. It centers on a few key components of discipline. First, revenue. The durable approach isn't blunt tax hikes. That just drives commerce underground or across the border. The focus has to be on enforcement and compliance. Strengthening customs to fight smuggling, improving VAT compliance, aggressively targeting evasion in high-yield sectors.
So you're preserving exports and employment because those are your only real long-term revenue sources.
Exactly. The second component is domestic borrowing. This is mainly done through war bonds, which mobilizes local savings.
And these bonds serve a dual purpose, right?
They do. They mobilize national savings in the local currency, which gives people a sense of participation, and they fund immediate domestic needs. But there are 2 big dangers. First, if the government borrows too heavily from commercial demand, it crowds out private credit and slows down private sector growth. Second, if you issue too much short-term, high-yield debt, you create a massive rollover risk when that debt comes due.
So the whole program has to be carefully calibrated.
Very carefully. To extend maturities and to coordinate with the central bank's overall macroeconomic stability goals.
Then there's the third component, spending discipline, or what the sources call budget triage.
At the end of the day, financing problems are spending problems. Wartime budgets have to be brutally honest. You prioritize defense and essential state functions. You defer or eliminate wasteful programs.
And that discipline isn't just about resource management, is it? It's also political.
It's hugely political. Clear priorities and visible burden sharing increase public acceptance of hardship. If citizens see discipline at the top, they're more willing to endure scarcity themselves.
And the clearest, hardest constraint on all this domestic financing is the monetary boundary. This is the line that separates solvency from hyperinflation.
A state cannot print its way to victory. I mean, it's that simple. Heavy reliance on monetary financing, the central bank lending directly to the government, it risks severe inflation and a currency spiral. That inflation acts like this insidious hidden tax. It erodes savings, it destroys the social contract, and it instantly repels external support.
Because donors won't pour money into a system that's actively destabilizing itself from the inside.
Of course not. The central bank's mandate has to be ironclad. Maintain confidence in the currency and protect foreign reserves at all costs.
Okay, let's move to pillar 2, official external support. This is the critical multi-year backbone that has to cover that vast recurring budget gap. And the publicly stated need for 2025 is what, around $39.3 billion annually?
That number is just staggering, and it underscores why this multi-year predictable commitment is the core strategic objective. Ad hoc funding, waiting for one-off votes in various parliaments, that guarantees instability. You need stable, programmed flows to stabilize expectations and prevent financial panic.
So let's detail the roles of the key institutional anchors here, starting with the EU-Ukraine facility.
The facility is the primary engine of predictability. It's designed that way. It runs for 4 years, 2024 through 2027, with a €50 billion capacity. Its strength is that it explicitly moves support away from crisis bargaining.
And toward a predictable, programmed flow.
Exactly. It's based on an agreed-upon reform and expenditure plan. The expectation of regular disbursements, like the €23.1 billion scheduled over 2025, that gives ministries the confidence they need for quarter-to-quarter planning.
Meanwhile, the IMF's extended fund facility, that functions less as a direct cash source and more as the ultimate macroeconomic anchor.
The IMF's role is absolutely indispensable because it confers credibility. The 48-month program, which is about $15.5 billion, requires adherence to a credible policy framework. Budgets, stability measures, governance benchmarks.
And you mentioned SDRs before. Can you just quickly explain what that is?
Sure. SDR stands for Special Drawing Rights. It's the IMF's own reserve asset, kind of like a synthetic currency that members can exchange. The point is, by requiring these regular reviews and sign-offs, like the $500 million they released after the 8th review, the IMF reassures all the other donors that the recipient state is sticking to a disciplined, intelligible plan.
So if the IMF is happy, the whole arch of external support holds firm.
That's the idea. And then you have the World Bank, which acts as the delivery workhorse, managing the logistics of disbursement.
The peace project.
That's right. The World Bank's Peace Project, public expenditures for administrative capacity endurance, is the main channel for sustaining those core government functions we talked about in Use 1. With over $41 billion dispersed through this specific mechanism since the start of the conflict, it just illustrates the sheer scale and efficiency of using these pooled, professionally administered channels.
Donors must love that. It replaces 30 different bilateral reporting systems with just one.
One standardized compliance process. It reduces transaction costs for everyone.
So the governing principles for this official support all have to focus on endurance.
Yes, and that means matching the instrument to the use. Grants for consumption, loans only for projects that can demonstrably generate future revenue. It also requires rigorous coordination through things like the Ukraine donor platform to prevent duplication. And finally, any conditionality has to be applied carefully. It should be rigorous, but appropriate for wartime. So you focus on measurable safeguards like procurement transparency, not sprawling, peacetime bureaucratic wish lists.
All right, let's turn now to Pillar 3. This is the most politically charged and legally complex component.
Yeah.
Russian asset-linked funding. The political appeal is just obvious. You're using the aggressor's immobilized sovereign assets to fund the victim.
The scale is significant. You have approximately 210 billion euros of Russian sovereign assets currently immobilized, mostly in Western Europe. A huge chunk of that is in the Euroclear depository in Belgium. The critical distinction operationally is this. Are partners using the flows, so the interest in windfall profits generated by these assets, or are they going after the stock, the principal itself?
And the current strategy heavily favors the flows approach.
It does, because it presents a much lower legal hurdle to clear.
Which brings us to the G7's extraordinary revenue acceleration model, the ERA model. What does that architecture look like?
The ERA model, which aims to deliver about $50 billion in loans, is essentially a very sophisticated leveraging mechanism. Partners front-load the cash to the state today, so they get the money now. And that loan is serviced and repaid over time using the future stream of windfall profits from the immobilized assets.
So you're pulling future revenue into the present.
You're accelerating it. The U.S. Treasury, for instance, disbursed $20 billion under this initiative back in December 2024. It turns a future revenue trickles into an immediate liquidity flood.
It sounds like a great political headline. Russia pays. But the analysis points out some really serious technical fragilities, starting with revenue volatility.
The revenue stream is inherently unstable. It's not guaranteed. The windfall profits that Euroclear generates depend heavily on high global interest rates and the existing sanctions regime. Both of those can change. The sources noted that flows reportedly dropped by about 25% in the first 3 quarters of 2025, just as interest rates started to moderate.
So this ERA mechanism can't be the single backbone of the whole architecture.
It can't. If the proceeds shrink, the ERA lenders face a real problem. They'll need alternative repayment sources or a messy renegotiation. So the whole design has to be built on highly conservative projections.
And the bigger fragility is the legal and political risk, driven by how Moscow is reacting.
Russia is actively challenging these measures in court. They're invoking sovereign immunity principles, framing this as unlawful seizure. And this isn't just a talking point. Russia's central bank has filed a claim seeking $230 billion in damages from Euroclear in a Moscow court.
An escalation designed to maximize uncertainty.
For Western financial institutions, for lawyers, it's all about raising the perceived risk of setting a precedent that could affect other sovereign assets held globally.
So we really need to rank these mechanisms by their inherent risk level.
We do. Using the windfall profits, that's the lowest legal risk, and it's already operational. The collateralized loan approach, the ERA model, is also operational, but carries that technical risk about future revenue flows. The highest risk, but also the largest potential sum, is the outright confiscation of the principal. the stock itself.
And that carries immense legal exposure.
Immense. It opens the door to potential Russian counter-seizures of Western assets, and it lacks clear precedent, especially in Europe where most of the assets actually are. So any asset-linked funding has to be designed conservatively with really robust legal guardrails.
Let's move to the final and maybe the most crucial pillar for ever achieving self-sufficiency. Pillar 4, private capital mobilization. This is what's indispensable for scaling up productive capacity and eventually transitioning away from aid.
Private capital holds the scale you need to rebuild an economy. There's just no question. But, as we noted, it is fundamentally allergic to war zones. The core problem is that the risks, physical destruction, sudden contract disruption, regulatory shifts, they're unpriced. And that are largely uninsurable in the commercial market.
So global private money will not flow in.
Until those risks are systematically transformed, broken down into variables that can be managed and priced.
So how does the architecture do that? How do you transform uninsurable risk into a managed variable?
Through layered financial instruments where public capital acts as disciplined risk absorption, you deploy war-bleed insurance against physical damage, partial credit guarantees to cover repayment risk, and blended finance structures.
Blended finance. You often hear that term. What does it mean in practice?
It usually involves using public first loss tranches to lower the barrier for entry for private firms.
Okay, can you break down what a first loss public tranche is? How does that actually function?
Sure. Let's imagine a reconstruction project, say building a new logistics hub. The total investment is $100 million. Private investors might be willing to put in $90 million, but they're terrified that the hub could be bombed. So a public entity, like a development bank, comes in and guarantees the first $10 million in losses. That's the first loss tranche.
So if a disaster happens, the public money takes the hit first.
It takes the hit first, insulating the private investor's principal against that primary catastrophic risk. And that small layer of public capital can dramatically crowd in a much larger pool of private capital.
And the EU investment framework is a real-world model for this de-risking logic.
It's an excellent example. The framework has committed 9.5 billion euros in financial instruments with the ambitious goal of mobilizing over 40 billion in total investment. The public funds are used for these guarantees and risk-sharing deals to incentivize banks and investment firms to come in. By 2025, commitments had already reached 5.7 billion euros, which shows that this structured risk-sharing can scale pretty quickly.
And of course, we also rely on multilateral anchors like the EBRD.
Yeah, and when institutions like the European Bank for Reconstruction and Development deploy capital, they provided 2.4 billion in 2024, they do a lot more than just provide cash. They signal credibility, they validate the investability of a critical sector like decentralized power or logistics. That lowers the perceived risk for co-investors, and it provides a template for how to execute these complex projects under high-risk conditions.
And the sharpest tool to address the risk of just physical destruction is war risk insurance.
This directly tackles that political and physical risk. The World Bank Group's MEGA, that's the Multilateral Investment Guarantee Agency, they launched a guarantees platform. It provides political risk insurance that covers things like expropriation, war, and civil disturbance. MEGA has already issued over 185 million in guarantees since the invasion began.
And other institutions are doing this too.
They are. The USDFC, the Development Finance Corporation, committed $50 million in new political risk insurance. And that's often paired with private structures, like Aon's $350 million insurance program. The message to the investor is crystal clear. The most catastrophic downside risks are now bounded by a credible public backstop.
But all of this complex financial engineering, it depends on a steady supply of good projects. The pipeline has to be investable.
That is the ultimate constraint. De-risking money is useless if the projects themselves are technically unsound or legally vague. So the pipeline has to focus on high-priority sectors, things that either restore foreign exchange earnings or reduce vulnerability, like energy resilience or export corridors. The overall goal is to create a virtuous cycle. You use public risk capital to attract private investment, which restores a productive economy, which generates tax revenue, which ultimately reduces the state's fiscal dependence on external aid.
This entire detailed structure, running all the way from monthly liquidity to reconstruction, it all hinges on Part 4, the operating system. Governance and oversight matched to each funding channel. Because financial resources are finite, but credibility, once it's lost, is extremely hard to get back.
Governance is the guardian of the entire coalition. That's not an overstatement. If citizens and donors lose confidence in the integrity of how these billions are being managed, the entire architecture will fracture. And so the oversight mechanism has to be highly specific. It has to be tailored to the failure mode of that particular funding channel.
Okay, so let's detail these channel-specific controls, starting with direct budget support, the money designed to keep the government running.
For massive budget support, the focus is on rigorous treasury controls and what's called ex post verification of expenditures, after the fact. Systems like the World Bank's Peace Project are used to consolidate, validate, and then reimburse government spending. This ensures that categories like salaries, pensions, and social benefits are real, documented, and traceable.
And this involves multiple layers of review.
Multiple layers. You might have the World Bank review combined with external governmental audits from donor nations. You're ensuring accountability without paralyzing the essential cash flow needed for survival.
Okay, now for recovery and reconstruction projects. The failure mode here shifts to procurement, corruption, and contract rigging.
So the control mechanism has to be radical transparency in contracting. Digital systems like Prozoro are a strategic asset here. Prozoro is an electronic public procurement system. It makes all public contracting data tender specs, bidder identities, final contract prices accessible for scrutiny.
Scrutiny by civil society, by competitors, by the media.
By anyone. So governance in this channel requires open competitive processes, real-time publication of data, and independent technical verification that the project was actually completed to standard before the final payment is released.
Defense support, on the other hand, needs a governance model that's rigorous but also adapted to security needs.
You can't apply peacetime bureaucratic rules to buying missiles. It just doesn't work. Governance here requires layering. Donor-side quality assurance on the equipment itself, meticulous end-use monitoring that securely tracks sensitive items to prevent diversion, and detailed post-facto audits done by cleared inspectors who understand security protocols.
So in-kind support, giving equipment instead of cash, reduces the risk of cash diversion.
But the governance challenge shifts to managing logistics, ensuring interoperability, and just reducing system waste.
And finally, for guarantees and insurance, the governance acts more like financial regulation.
The risks here are different. It's about political favoritism in issuing coverage or weak underwriting standards or just fraudulent claims. So a credible guarantee or insurance platform requires transparent, publicly known eligibility rules. It needs independent underwriting review by actuarially sound bodies, and it needs clear standards for claims adjudication and audit trails.
The public money used to backstop the risk has to be disciplined risk capital.
Not a politically controlled slush fund.
Exactly. This reliance on all these channel-specific controls means that the broader institutional integrity of the state is the ultimate governor of the entire architecture.
Absolutely. All of these specific controls, they depend on a functioning rule of law ecosystem. Support from external partners, particularly from the EU facility, is explicitly tied to measurable progress on budget oversight and anti-corruption enforcement.
And the political sensitivity of this is extremely high.
We saw that. Protests back in July 2025 followed legislation that seemed to threaten the independence of anti-corruption agencies. That demonstrated how quickly negative governance signals can affect donor confidence and put billions in aid at risk.
Credibility is fragile. It has to be constantly maintained.
Constantly.
Okay, our fifth and final part addresses what might be the highest hurdle of all: political sustainability. This is what the sources call the hidden fifth front, keeping the funding coalition intact when global crises shift and donor tiredness inevitably sets in.
The financial architecture is only sustainable if the political will behind it is institutionalized. Support cannot rely on episodic emotional urgency or the personal relationships between leaders. It's just not durable enough. The architectural solution is to convert that episodic charity into durable institutional policy mechanisms that lower the risk of those annual funding cliffs.
And the European Union provides a strong blueprint for how to do that, for institutionalization.
The EU-Ukraine facility, running from 2024 to 2027, is the prime structural example. It embeds support into a multi-year programmed budget. That makes it much harder to interrupt on a whim. And beyond that, the EU adapted its own internal procedures, like indefinitely freezing Russian assets, to ensure that individual member states couldn't easily use veto threats to derail the overall continuity of support. That's crucial coalition maintenance.
In the United States, political sustainability often relies more on bipartisan framing and using specific policy vehicles.
Right. Support is often secured by embedding aid into necessary must-pass legislation, things like the annual National Defense Authorization Act.
as opposed to standalone crisis votes, which are much easier to block.
Exactly. And you also see the use of off-budget mechanisms, things like guaranteed loans under U.S. aid that are anticipated to be repaid by Russian asset revenues. This helps manage the public narrative by making the support seem more financially responsible and reducing the appearance of just open-ended taxpayer exposure.
But institutionalization isn't enough on its own. The architecture has to actively manage its own legitimacy through visible outcomes.
Coalition durability relies on transparency and performance. It really does. Partners have to consistently communicate concrete, measurable results. Not just, we spent this much money, but this is what the money bought. Pensions were paid, the electricity grid was repaired, export corridors were secured.
And you pair that with demonstrating clear domestic burden sharing.
That disciplined, results-oriented communication is what counters the corrosive narratives of cynicism or financial unaccountability.
And finally, we need scenario architecture. We have to prepare this financing model for radical uncertainty. The whole plan has to be modular, built to bend without breaking.
Stewardship requires pre-wiring the financial system for different scenarios: baseline, stress, and upside. You have to pre-plan the contingencies so that a shock, whether it's a political blockage of aid or a major military setback, doesn't instantly become a financial cliff that causes panic.
The IMF regularly frames the outlook as unusually uncertain, which makes this kind of proactive planning non-negotiable.
It has to be part of the design from day one.
So let's detail the financial responses for these three potential futures. First, the baseline scenario: disciplined continuity.
This is the desired outcome. The war continues at its current intensity, the external backbone from the EU and IMF holds, domestic discipline keeps inflation low, and the asset flows contribute a reliable supplement. Private capital starts to enter selectively in those de-risk sectors like energy and logistics.
And success here is defined pretty simply by financial stability.
That's it. No inflation spiral, no missed payrolls, and you're making incremental progress on bankable reconstruction projects that keeps the political coalition viable.
Okay, second, the stress scenario: surviving without breaking. This would be triggered by a major pillar failing, a donor blockage maybe, or a sharp decline in Russian asset proceeds.
The response here has to be a set of pre-planned actions. The state must automatically activate fiscal triage. You pause low-priority capital outlays and non-essential spending immediately. You activate liquidity buffers. You intensify domestic measures like a radical enforcement of tax compliance. And crucially, you engage in immediate, radical transparency with your allies to maintain the coalition and secure emergency grant support to prevent a devastating debt spiral.
And third, the upside scenario: security improves and investment starts to flow back in.
As security improves and that war risk premium drops, official support has to pivot. And fast. You shift from financing immediate consumption pensions and salaries to catalyzing massive investment. Guarantees and blended finance become potent multipliers. Domestic finance improves rapidly as the economy grows.
And the primary risk in this scenario is actually mismanaging the momentum.
It is. The risk is abandoning macro discipline or visible anti-corruption enforcement. You could convert necessary optimism into speculative, high-risk borrowing that risks the entire recovery.
So across all these possible futures, the message is that the structure has to be robust enough to manage the unforeseen.
That is the goal. The long war finance problem requires an integrated, multi-layered model. You have to match the four distinct uses: state ops, defense, recovery, reconstruction, to the appropriate tools: grants, loans, guarantees, and asset-linked mechanisms. It can't succeed through partial application. It's all or nothing.
So to sum up, what are the non-negotiables for this sustainable architecture?
First, disciplined macro stability. You have to maintain that monetary boundary and reject uncontrolled monetization. Second, predictability. You have to secure multi-year program support to prevent those funding cliffs. Third, debt discipline. Use grants for consumption. Only take out revenue-supporting IOUs that will not tax the future recovery. Fourth, legal and political durability. Ensure those asset-linked funding mechanisms can survive challenges in court and in parliaments. And fifth, governance matched to the channel. Strict, auditable controls where corruption risks are high, and streamlined speed where survival is critical.
And this is where it gets really interesting for you, the listener, to consider. The financial architecture itself is much more than just a technical exercise. You could see it as a moral project of good stewardship. If credibility really is currency, and a state is asking its citizens and its allies to continue investing in its future, what does a society owe to its own future solvency?
That's a great question. Because this clarity and discipline in financial planning, which we often view through a purely technical lens, it has a profound impact on public morality and national resolve during a prolonged struggle. If a state manages its resources responsibly, if it converts today's external aid into tomorrow's internal revenue generating capacity, it reinforces the national belief that the struggle is ordered and ultimately winnable. That visible, sober discipline, that is what sustains the people, not just the budget.
A compelling thought for you to carry forward as you analyze major policy decisions. Thank you for joining us for this examination of financial endurance. Be well.